In a global environment rendered highly volatile and uncertain by diverging monetary policy actions and monetary policy stances by various central banks, geopolitical tensions, elevated crude oil prices, and persistent supply bottlenecks, emerging economies are vulnerable to destabilizing global spillovers on an ongoing basis. Thus, policymakers face daunting challenges even as recovery from the pandemic remains incomplete. On its part, the Reserve Bank has been and will continue to insulate the domestic economy and financial markets from these spillovers. Further, while the RBI will continue to focus on smooth completion of the government borrowing program, market participants also have a stake in orderly evolution of financial conditions and the yield curve. It is expected that market participants will engage responsibly and contribute to cooperative outcomes that benefit all. Let me now proceed and make a few additional measures which we have decided, and let me now go and announce some more additional measures. The first one relates to extension of the on-tap liquidity facility for emergency health services and contact-intensive services. On-tap liquidity facilities of rupees 50,000 crore and 15,000 crore for emergency health services and contact-intensive service sectors, respectively, were announced in May and June 2021 during the second wave of the pandemic. Banks were given certain incentives for lending under the two schemes. On account of the continued uncertainties brought on by the third wave, the two schemes are now being extended from 31st March to 30th June 2022. Next one relates to the voluntary retention route enhancement of limits. The voluntary retention route scheme, that is the VRR scheme, it's different from the VRR which I referred to earlier, that related to the repo operations. So this is the voluntary retention route scheme, was introduced in March 2019 to facilitate long-term investment by foreign portfolio investors, that is FPIs, in debt securities issued by the government and the corporates. The response to this scheme has been very encouraging. It is therefore proposed to enhance the limit for investments under this scheme by rupees 1 lakh crore from rupees 1.5 lakh crore at present to 2.5 lakh crore with effect from 1st of April 2022. This will provide access to additional sources of capital for both domestic debt market, including the government securities. Next announcement is as follows. The guidelines for credit default swaps, that is CDS, initially issued in 2013 were reviewed, and draft guidelines were issued in February 2021 for public comments. Taking into account the feedback received, the final CDS directions are being issued today. These guidelines will facilitate development of a credit derivatives market and deepen the corporate bond market in India. The next announcement relates to permission to banks to deal in foreign currency settled rupee derivative markets. Banks in India have already been permitted to offer rupee interest rate derivatives such as overnight